Welcome to Retirement Unlocked with Larry Heller. Your life, your way, unlimited possibilities. Join us as we explore how tailored financial planning and investments can help you navigate life transitions with confidence. Let's dive into this week's episode.
And welcome back to Retirement Unlocked with your host, Larry Heller. Joining us today is Gregg Schor, CEO of Protegrity Advisors. With more than 25 years' experience in mergers and acquisitions, corporate development, and leadership roles at some major companies, Gregg brings a deep understanding of what truly drives a successful transaction. In this episode, we break down the essentials, the different types of buyers in today's market, how sellers can evaluate their options, the ideal time to consider a sale, and what preparation really looks like. Gregg also walks us through a full M&A process from initial planning to closing so business owners know exactly what to expect. Whether you're thinking about selling now or planning for the future, this conversation offers practical insights you won't want to miss. So, Larry, get down to it.
All right. Thanks, Bill. Thanks, Gregg, for joining us today. I think we'll cover a lot of ground that some of our listeners will be really helpful for some of our listeners. So why don't we kind of jump right in and kind of talk about, selling your business the right way. And so when a business owner is thinking about a sale, what are the different types of buyers that are out there in today's market?
So today's market, there's actually a broad spectrum of buyers and really more than ever before. So you have the strategics who have always been there. So, a company that operates in the same business sector or something adjacent to it, could be public, private, US or international. So that they've always been there. But there's been a proliferation of private equity firms of all types and sizes. So a PE firm is really an investment entity that pools capital from private investors, from institutions, from other funds to acquire, manage, and ultimately sell companies at a profit. And then you have family offices, which are kind of the private wealth management entity, which manages the financial affairs of high net worth families. Now, the family offices used to really just invest their money in private equity firms, and they decided, I guess several years ago to kind of knock out the middleman. And now the family offices invest directly in companies as well.
So if I'm a seller, should I be concerned about which one of these? Are there pros and cons for the buyers, or is it just doesn't make a difference? I should just take the highest price?
No, it definitely does make a difference. It depends upon what the objectives are of the seller. Some objectives, some sellers would like to retire. Some say, I'd like to stay another year or two and then go. Some say, 3 months, 6 months that I'm going to transition. And some say, hey, I'm good for, as long as it's a role that I like, there's I'm good for 3 years, 5 years or more. Some sellers, want, they want cash at close. They're old school. And I counsel our clients, the only thing you can ever count on is the cash amount at closing. If there's any type of earnouts or bonuses, the company's not under your control anymore. So you don't know what will happen. We'll do our best to negotiate very attainable objectives and thresholds to get those additional payments. But the bottom line is they don't run the company anymore, and you have to be happy with the cash at closing. A strategic will typically want to buy 100% of a company because there's not going to be another exit planned. And the strategic will typically have a management team in place already. So unless there's some compelling reason for the owner to stay on, maybe they have great relationships, maybe they could take on a different role. Sometimes an owner can even join the corporate development department of the buyer because they may know of other companies that could be ripe for acquisition. But usually you're not going to stay, the majority of times you're not going to stay for any kind of extended period of time. A private equity firm, in contrast to the strategic, will typically never want to buy 100%. It's the exception where they do. They usually like to be in the 60 to 80% range. they view the owner having what's called rollover equity as some type of insurance and incentive that the owner is going to make sure that the transition post-transaction goes well, and kind of the representations and promises that were made are going to be kept, that they have a financial interest in that. The rollover equity, it's a risk reward thing, right? You have no idea whether you're going to be able to recoup on that, but if you do, sometimes it's what it's called in the industry, the cliche, it's a second bite of the apple. That second bite of the apple could be larger than what you got on the first transaction. So, the benefit is you get to take cash out, and you may have a second hit in X number of years. Usually, private equity firm would like to sell the business again within 5 to 7 years, or the ones that are in that particular fund. A family office is kind of a mix. So it's always best to sell 100% to a family office, because they're not motivated for a future sell. They're fine if the company is doing well, if there's profits and distributions. They don't need to sell it. If something comes along, if they get a great offer that comes along, but they're not going to be proactive in that respect the same way that a private equity firm will be. So if you do get rollover equity in a family office situation, you would want to have some type of right, if there's no liquidity for that equity that's held in X number of years, to have the right to sell it. Also, a family office will many times want the owner to stay for some extended period of time, as opposed to a private equity firm that many times they have their own bench of executives that, they purposely look for companies in certain sectors because they have someone in mind already who can run it, or they have a platform already. And if it's an add-on to that, again, they have a management team in place.
You mentioned the cash up front and the equity, but you also talked about the earnout. Can you just kind of give an audience a little bit more of like, what is that? How is that usually set up? Why is that important?
Sure. So what happens is when we go through a transaction, typically you go back 3 years for the financial statements, the P&L, the balance sheet, you make the adjustments. We end up doing the opposite of what the accountant does, right? The accountant wants to minimize profit on the books so that there's the least amount of taxes that are paid. We do adjustments and add backs and normalize things and push the envelope. Everything, fully credible, supportable, but we want to show the most amount of profit on the books, because that's typically how a company is valued. It's some multiple of the adjusted earnings. But we also do projections. So a buyer will say, the seller will say, hey, I'm going to do, 10 million this year, with another 2 million in adjusted earnings at the end of the year. If I'm getting a 5X, if it's a 5X multiple, then, the purchase price should be this. And the buyer will say, well, you haven't achieved that yet. So we can't pay you on for the future, but what we'll do is we'll create an earnout situation where if you hit X, Y, and Z milestones, whether it be revenue, whether it be adjusted earnings, whether it be customer retention or something else, then you will get paid additional funds at that time. So it's like a bonus. But, as I mentioned, and I repeat this all the time because it's important, as we tell our clients, cash at close, is the only thing. You have to be happy with that, and you have to view any earnout as a bonus.
Right. And sometimes you may have all three: cash plus an earnout plus equity.
Correct. Yes.
So, can you just touch a little bit about the different types of sales, kind of like an asset sale, stock sale that you see? What's the tax ramifications of this? Are you seeing more? Is it strictly mostly asset sales? How do you see that? What's going on?
Yeah. So I'll only, I'm dangerous when it comes to taxes. We rely on the client's accountant. Typically, a buyer is going to want an asset sale because they don't want to inherit past liabilities from the company, right? So if they do a stock sale, then they step into the shoes of the company, and they could be liable for prior claims. So now that will be addressed in the agreement, but and you really can't blame them. The buyer doesn't want any aggravation from anything that occurred prior to them taking ownership of the company. There needs to be a compelling reason. sometimes a compelling reason could be if there's any licenses associated with the business, or maybe contracts can't be assigned. But if they step into the shoes of the of the seller, then you don't have to go through maybe getting consents of all the customers or suppliers. If you're if you're a seller, you want a stock sale because you want to maybe offload some prior responsibilities. But there's also you get taxed at a much lower rate than if there was an asset sale. So there's kind of conflicting interests. Sometimes what we're able to negotiate is, even if it's an asset sale, we get the buyer to gross up the purchase price. So the net effect is that from a financial perspective, is the same as if it were a stock sale.
Yeah. So when is the best time for an owner to consider selling, all or maybe part of their company?
The best time is really when the company is doing well. We speak to many business owners who say, company's doing great. Why would I think about selling now? And we say that's the exact time to think about selling, is when you don't need to. You don't want to wait until the business is on a decline and there's issues, or the market looks like it's, for your type of product or service isn't as robust as it used to be. You can get the highest valuation, you can get the best non-financial terms, and you can get the best purchase price, and you can walk away, right? You don't need to sell. And that's actually when you're the most attractive.
Mm. So, and when should someone start really considering, they decide, I want to sell, but, people think that, they wait to that date and then it's just going to be like that and sell. So at what point should they really start either talking to you or start to thinking about selling the business at some point in the future?
There's really no time like the present to start preparing. Certain things from a tax perspective, you may need to do, between 1 and 5 years ahead of time to minimize your tax exposure. You want to get your house in order before you're under the magnifying glass of a buyer. So, I think I mentioned earlier, usually buyers want to go back 3 years for the financial statements, so the P&L and the balance sheet. You want to get that in order. You want to make sure that it could withstand due diligence. Many times our clients, really the financial statements are just for tax purposes. If there's any kind of bank loan or, line of credit, then there's usually kind of a higher standard that's required from the banks with respect to the financial record keeping. But if that's not the case, as happens often, again, the financial statements are really just a tool for tax purposes. Inventory is another thing that becomes a major issue in transactions, especially if it's some type of manufacturing business or distributorship. Many times the inventory is not accurate. It's kind of backed into during the end of the year, again, for tax purposes. You want to clean up contracts. Sometimes contracts, as we discussed, are not assignable. Sometimes there's no contract in place. Like, we've had conversations with clients where, do you have a contract with your main customer or main supplier? And it's, I know them for 30 years. We don't need a contract. We just have a handshake. I said, but that, that's not going to suffice with a buyer. That presents too much risk. So let's get a contract, in place. Also, is the owner too critical to the running of the company? That's a bad thing when it comes to valuations and purchase prices and attractiveness to buyers. That presents too much of a risk. They don't want key relationships to be with the owner who's leaving. Mm-hmm. They want a management team. The best thing you can do as an owner is to put yourself out of a job and make it so that you're not needed and the management can go on without you. That's actually when the company is more valuable. And and I'm sure there's things from your perspective as a financial advisor on steps that business owners should take well in advance.
Well, I know one of the things from an accounting standpoint, and I don't think anyone from the IRS is listening right now, but a lot of business owners put a lot of things through their business. So you kind of want to clean all those up beforehand, right?
Yeah. So we normalize and make adjustments for it, and everybody knows that that's, what's done. So what we'll do is when we create our financial model, we'll have a listing of here's all the add backs and here's all the reasons for it. So, it's not only personal expenses as you mentioned, but sometimes there's, one-time expenses that wouldn't happen on a recurring basis. Maybe there was a major repair or a major purchase. We can actually pull those out, and so that the profitability of the company is going to be higher. As a result, because when we do the financial modeling, it's normalizing things. So what would, in a normal year, what would the expenses? So even if there was like a major litigation or something, and there was 100,000 or 200,000 in legal fees, that would get added back and would kind of go on the profit side rather than, on the expense side.
Right. So is there like anything a prospective seller should be looking for?
In terms of,
When they're going, when they're starting to put the business up for sale, is there kind of I know I've talked to some business owners and what I've told them is, what are some of the deal breakers? What are the things that you want? So, some said, I'm not going to sell to a private equity firm or, so are there any specifics there that, you kind of guide your clients through?
Yeah, well, we ask them what's your objectives? Do you want to, obviously the dollars are important, but what else? Do you want to stay? If yes, for what period of time? Are you, are you willing to leave some equity in, or do you want 100% and be done? Is keeping the name of the business the same important to you? Is keeping the location the same? Obviously, the majority of the owners want to make sure that their employees are taken care of. Are there going to be reductions? So those are the, kind of the types of things that we would like to know. Are there family members in the business that would want to continue and stay, and stay involved? So we try and match what the objectives are of the client to the kind of the matrix of buyers that we have. So it's good for them to be thinking about all those types of things that are in addition to the, monetary objectives.
So, why, someone's thinking about selling, why work with an M&A firm? Is there a process kind of that you do, and why should somebody work with an M&A firm?
For a few reasons, and, I may not be objective when it comes to this, but you need to focus on running the business, right? That's what and the last thing you want to happen is for revenue or earnings to go down when you're ready to sell it. You want it to continue, you want an upward trend. You also don't want anyone finding out. You don't want employees, customers, suppliers, certainly not competitors, knowing that you're contemplating a sale. So we act as the single point of contact and everything goes through us. We want to handle the, I say 80% of the questions that come in from potential buyers, so we don't disrupt or distract the business owner. We know how to run a competitive process. Sometimes clients come to us and they say, well, I was approached by someone and I want to sell to them, but it's, how do you know that you're not leaving money on the table? You have really no idea what your business is worth in the market. So that's one of the first things we do is do evaluation. Sometimes the initial one we call a preliminary evaluation, where we give the client a very good feel for what we think the market commands, what think that their business will command in the market under current circumstances, and why. It's good information for them to have. It helps them decide, do I want to go to market now or not? We can also advise them. We think if you do X, Y, and Z and wait 6 months, 12 months, you'll see an appreciable difference. So we'll take you to market now, but we recommend that you wait and make these changes. It's the analogy is, do you want to sell your own house or do you want to use a realtor? Where are you going to get, where are you going to net a higher amount? What we find is we could typically get our clients many millions more than they could get on their own. So even with them paying us, they still end up way ahead of the game because of our involvement, because of our connections, because of our positioning, even if we stick with the one buyer that had approached them, we can still get the purchase price up. The buyer now knows that if they don't make a, what is a fair offer, that we can now just take them to market. So that now they have some external pressure to make sure they're not just going to lowball. See if the client says yes.
You mentioned, positioning. Do you, I've seen, some M&A firms, they talk about the SIM and why it's important. Can you just touch on that for a second?
Sure. So the SIM, on the confidential information memorandum, it's the story of the company, right? So it has the history, it has description of the products and services. It has, we typically put, some timeline of milestones. We'll put the organizational chart, but we won't put any names in it. It'll just be titles. And very importantly, we'll put the growth story. So this is what a buyer could do to take the company to the next level. Like, a buyer is not necessarily looking, there has to be a good foundation, but they're not buying it because of what you did in the past. They're looking at what they can now do in the future moving forward. So the growth story is a critical part. And the SIM, a potential buyer has to sign a non-disclosure agreement before our client gets disclosed to them, before they can receive the SIM. It helps qualify interest further, right? So they take a look at the book, and certain percentage of them are going to say thanks, but no thanks. But some are going to say, hey, I would like to know more. They'll come back to us with questions, maybe end up with a site meeting. But you want to put the information out there because time is critical. Also, the client is kind of, we stage it, but they're opening their kimono, right? They're sharing information, and you don't want to do that unnecessarily. You want it to be qualified and staged. So the SIM helps to do all those things.
So, and obviously, working with a firm that puts together a better SIM may get you, like you said, millions of dollars more by how you're positioning this. So, last question: how long does it take the M&A? How long usually does the M&A process takes, and kind of what happens after you kind of have a verbal agreement?
The verbal agreement with the buyer?
Yes.
Okay. So the whole it depends upon how prepared or not the seller is, and even time of year is impactful, right? Because we don't go to market now because a lot of people are going to be taking off in towards the end of the year. The typical process will take somewhere between 9 and 12 months from engaging with us for early conversations to closing. Could be a little bit more, could be a little bit less. A lot of it depends upon getting the financials from the client and how fast they could do that. End of month, end of quarter. Some can do it faster than others. And it's critical that they kind of get into that routine where every month we get updated financials, because those need to go to the buyer. I mean, it takes us from when we initially go to market, and we'd use the blind teaser first to contact the targets. Those that are interested in signing the non-disclosure get the SIM. It usually takes us, let's say, 1 to 2 months to have the financial model in place and have the marketing materials. And the client approves everything. They approve the targets, they approve the SIM, they approve the blind teaser. Usually takes, like I said, 1 to 2 months. Then a couple of months in market, answering questions, arranging site visits, filtering out who might be the best candidates, fielding the offers. Many times they'll put a deadline and say offers must be, provided by a certain date. Then you get a letter of intent. So we don't, go to due diligence on just a verbal is definitely helpful, and it helps us to kind of focus on a few. Once the letter of intent is signed, that's when things really kick into gear with respect to due diligence. We caution clients that a letter of intent doesn't necessarily cost anything for a buyer, except when they really get their lawyers and accountants involved, because now they're spending real money. So that they're interested. The letter of intent, really the only obligation or restriction is on the seller, is on our client, because there'll be what's called the no-shop clause that's incorporated into that usually says, because the buyer's going to say, because we're spending money on accountants and lawyers and other advisors, we don't want you to continue shopping the company. So you can't talk to anybody else for, They usually start with 90 days. We, try and get it down to 60 days. Sometimes you compromise in the middle. So then we're working on due diligence, which, can be very stressful for a client, especially if they've been in business for many, many years and they're very contract intensive. And due diligence can take easily, 1 or 2 months, depending upon the type of business. And I even tell clients, there's going to be 1 or 2 times during this process where you're going to get so frustrated, where you're going to say, you know what, forget it.
Mm-hmm.
I'm done. I'm not doing this. They've asked this question already. I've given everything. It's just, it's just too frustrating. The next morning they're fine again. And the deal is back on track, but it's normal. It can be very stressful, but we're here to, to take off as much of the stress off of the client's head as possible. About halfway, 2/3 through the due diligence process, when both sides are comfortable that there doesn't seem to be any deal breakers, the buyer will provide the asset purchase agreement or the stock purchase agreement, whichever type of sale it is, and that'll start getting negotiated in parallel. That could take, a month, 6 weeks, something like that. Again, it depends upon the type of business, if approvals are needed, if there's licenses involved. And then, then it's typically a simultaneous signing and closing. But again, figure 9 to 12 months.
Great. All good. A lot of great information. If you're a business owner and you're thinking about selling your business, Gregg, where can they reach out to you to contact you?
Yes. So our website is protegrityadvisors.com. My number is 631-285-3172. And my email is gschor, GSCHOR, @protegrityadvisors.com.
Great. Thanks so much for joining us today, Gregg.
Thank you, Larry. I appreciate it.
Interesting conversation. And Larry, thanks for bringing us that conversation. And listeners, thank you for joining us on Retirement Unlocked. If this episode gave you a clearer understanding of the business sale process, be sure to like, subscribe, and share it with a fellow business owner who might benefit. Remember, a successful sale starts with smart planning. So let's begin that conversation today. We'll see you next time on Retirement Unlocked.